You think banks just hold your money. You think they're safe, boring, regulated. But every day, without you noticing, they quietly shape what you can buy, how you live, and even how the economy itself bends around you. And the truth is, most people have no idea. It starts with a number, or rather a series of numbers. The average checking account balance in the US is around $5,000. That's nothing compared to the trillions banks move every day. Banks don't just store money, they create it. Not literally, of course, like printing bills, but in a way that matters even more. When a bank approves a loan, it doesn't take money from someone else's account. It creates new money out of thin air. It appears in your account, and suddenly, the economy has more money circulating than before. You thought lending was about giving money, but really, it's about generating it. And that's just step one. Banks control how fast that money moves. Interest rates aren't random numbers set by the Federal Reserve, they're signals. A 2.25% change doesn't just affect mortgages, it subtly nudges billions of decisions. Will a company expand? Will someone buy a car? Will a student take on debt for college? Every swipe of your card, every loan application, every rate hike quietly guides choices in ways most people never notice. Consider mortgages. In 2008, banks were lending aggressively, bundling loans into complex securities and selling them to each other like hotcakes. Homeownership seemed accessible, but it wasn't just about houses, it was about shaping perception. People felt wealthier, spent more, and unknowingly became part of a system where debt was everywhere. When the bubble burst, the losses weren't just financial, they rewrote the life plans of millions. Careers stalled, retirement accounts shrank, dreams were delayed. And most of it happened because banks had quietly engineered incentives to borrow, spend, and trust the system. It's easy to think this only affects the ultra-wealthy or giant corporations, but the influence trickles down. Banks decide who can get credit and at what cost. Your credit score doesn't just measure how responsible you are, it measures how profitable you are to them. Lower scores mean higher interest rates. Higher scores mean easier access. Every transaction, every missed payment, every small financial decision feeds an invisible scorecard. And that scorecard shapes your choices, where you live, whether you can start a business, even which jobs are feasible. Then there's leverage, the quiet multiplier. Banks rarely keep all the money they hold in reserves. Fractional reserve banking means they only need a fraction of deposits on hand. The rest can be lent out, multiplied, and turned into even more loans. $1,000 deposit can generate $10,000 or more in credit across the economy. That sounds abstract until you realize the scale. It's how economies grow, but it's also how crises snowball. A single default can ripple into millions of people losing jobs, homes, or savings. Banks shape risk, sometimes wisely, sometimes dangerously, and the public rarely sees it until it's too late. Ironically, the systems we trust to protect us are also the ones amplifying instability. Banks benefit from confidence. They need you to believe your money is safe, your credit is fair, the economy is stable. Yet under the surface, every loan, every derivative, every interest calculation is a careful balance between profit and fragility. It's a high-wire act with billions of lives dangling below. Let's zoom out a bit. Think globally. International banks don't just shape local economies, they influence entire nations. Currency swaps, sovereign lending, cross-border investment flows. A single decision in New York or London can ripple through Africa, Asia, or South America. Economic policies, trade agreements, and even elections can be nudged by credit availability or interest rate adjustments. Banks are not neutral actors, they are strategic power centers, quietly steering global flows of capital and influence day by day, transaction by transaction. And yet, for all this power, the system is built on trust. Trust that debts will be repaid, trust that depositors won't panic, trust that banks will regulate themselves. It's a paradox. The more we rely on banks, the more the system becomes fragile. A small shock, a sudden withdrawal, a bad loan, a currency devaluation can cascade, reshaping lives faster than anyone realizes. So the next time you swipe your card, take out a loan, or even check your account balance, remember, you're participating in a system designed to move money in ways you don't fully see. Some of those moves help the economy grow. Others create hidden risks that show up years later as crises, inflation, or financial stress. And all of it is engineered quietly, invisibly, inside the walls of institutions most people treat as neutral. Banks shape our lives not with force, not with law, but with numbers, incentives, and subtle control over opportunity. And the unsettling truth is, unless you understand it, you're not just a participant, you're a passenger. What if the next crisis isn't caused by greed, mistakes, or poor policy, but by the very system we take for granted every day? A system we've all grown dependent on, yet barely understand. And the most important question remains, will we notice in time, or only after the next wave hits?